You need to have a move-in ready house that needs no repairs if you want to sell in this market. Now, I think my house is worth $520. Well, you've had it for sale by owner for 3 months and everyone's told you your house is overpriced. And I'm telling you your house is overpriced. Update the pricing. What I mean by that is lowering the price. If it didn't sell for this, it ain't gonna sell for that. New builds have always been tough, at least, for your local, we call them onesie twosies, they build a few houses a year. Because they always do cost overruns. Not always, most of them spend a little bit more than the budget. And pretty much way too optimistic with the eventual sales price. It's like, hey man, if you build this, I'm like, hey, if you build this, it's gonna move at $499. And they call me. It's like, all right, I need $565. It's like, you're not going to get that. So then the months roll on. They're frustrated. They did all this work. It's their baby. So new builds always have been difficult. And also be careful when you're working with investors, because investors can suck the life out of you just like a builder can, right? They want you to find them lots. So you're looking all around, trying to find off-market building lots. You find one for them. Half the time, they just go buy directly from the person that owns a lot. You get cut out. Or you do a bunch of work on land, and land is a high or low purchase price. Flow. So now it's like low purchase price, bunch of headaches, right? Because when you buy land, you have to verify you can do what you want to do with it. When you buy something that has a building on it, land with a building, you already know what you can do because it's there. So you do a bunch of work to get the builder a lot. And then they overbuild it because they always do. And then they want more than you can sell it for. And you got yourself like this freaking, and it's your fault. If it sells, it's your fault, which is a good thing, right? But then if it doesn't sell, it's your fault. So we got that place up on Skyway. It's priced well. It's not priced well, because it was priced well, I wouldn't be saying it's priced well, right? Same thing when you're meeting with a seller and you're filling out your disclosures, the stuff does tie together. And they say, okay, well, there's this thing with our house. Should we disclose it? The answer is yes. If you're wondering whether or not you should, the answer is yes, right? So like if you're asking the question, then you already have the answer. Oh, should I tell my wife about it? Yes. If you're wondering if you should tell your wife, the answer is yes. There's not a really, right? So if you're like, oh, I priced it well and it's not selling. Okay, by virtue of you saying you priced it well and it's not selling, that means you didn't price it well, right? Because if you did, it'd be gone. Because we're interpreting the market. We don't make the market, right? So this is what we're doing today. Is we want to interpret the market. So when I'm valuing, I did one last night. I had 2 listing appointments yesterday. I woke up and was like, oh, shoot. They're like, what about price? Is it too high? Is our price too high? Should we start lower? I'm like, guys, I don't know. Like we do our best to interpret the market. The only way to really know is we put this thing on and see what happens. A couple weeks, no activity. You and I will both know pretty fast that we need to update our pricing, which means lower it. Sometimes when we avoid the key words like drop the price, lower the price, they're like, oh, okay, update it. So we could go up or down with it. Maybe we should up the price. It's like, no, if it didn't sell for this, it ain't going to sell for that. So being specific with your wording, update the pricing. What I mean by that is lowering the price. Like, yeah, we get it. So when I call you, say, hey, we need to change the price. Don't be talking about going up. That's the wrong direction. I'm like, no, we're good. But it's 2720 Montara. It was on the market a couple years ago for $689. Didn't have any movement. I feel like 685 is a fair number based on comparables. But I really don't know. What we feel today, they'll report in the news in 2 to 3 months, right? So rates were coming down. Things are looking good this spring. And then boom, we start bombing the shit out of Iran. Gas prices shoot up, interest rates shoot up, and the market softens, right? We got used to that a little bit. Get the PC thing with Iran, which is crazy that Iran's affecting, but it does because it's mental. The stock market trades based on feeling. not on fundamentals. The real estate market, ups and downs, trade on feelings and fundamentals, but the feelings have a big deal. So we're starting to get some momentum. Then we start bombing the shit out of Iran again. Oil starts going up, interest rates start going up, and you feel the pullback again. You can feel it within a couple weeks. Like we had some showings and boom, it stopped. So I'm going to take a break. I don't know. What this means is when I can take actives and I divide it by pendings in the past month, I am calculating months of inventory. If nothing else hits the market for 3.47 months at the current absorption rate, the rate of sales, there would be nothing left to buy, right? Because 61 homes sell a month and there's 212 homes for sale. So it will take, at the current rate, 3.47 months at a rate of 61 closings a month to eat up this inventory. Now, we know that there will be houses on here that never sell. There will be houses on here that sell faster. They may withdraw from the market, expire, cancel, etc. So it's not like you could pause all actives and these would be gone in 3.47 months. But this is a good way to calculate what kind of market you're in. The market absorbs houses, okay? So the general wisdom was 6 months of inventory is a balanced market. More than 6 months of inventory is a buyer's market, which means there's lots of people wanting to sell and not that many people wanting to buy. Less than 6 months was a seller's market, which means there's more people looking to buy than there were looking to sell. I don't think 6 months is the marker anymore. I think it's 3. 3 months is a balanced market. Over 3 months is a buyer's market. The buyers have the upper hand. Under 3 months turns into a seller's market. Like when rates were, let's say, uh, 2022, we had 2 weeks of inventory. 2 weeks of inventory. That means if no new houses hit the market for 2 weeks, everything would be gone. And that was a fun market. That was a good market because you didn't really have to price them that good. There's 2 weeks of inventory. It's like if you had a pulse, you were selling houses. Like you just had to wear a Rutledge shirt. It's like, do you know of any houses I can buy? You do? Can I have one? You'd be like, nah, you look funny. I'm keeping this house. Somebody else that I like better than you. No, 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 we'll pay more. We'll pay more. We'll pay you more. We'll pay everything more. Right? But now, is it that way?
Here's a list. Fix it.
Yeah. Oh, your house has dirty carpet. Get fucked. She's like, oh, listing appointment yesterday. Hey guys, you need to replace the carpet. We're not going to replace the carpet because if we replace the carpet and they want to put hardwood, everyone's wasting their money. And that's why. I said, okay, your house isn't going to sell. What do you mean? In this market, buyers will not put up with or purchase a home that needs work and pay your price. We'll price it accordingly. Drop it $100,000. What are you talking about? Carpet's only $5,000. If you want to price it accordingly, you need to make it a good effing deal, not an okay deal. You need to have a move-in ready house that needs no repairs if you want to sell in this market. Because like Andre said, here's the list, fix it, right? So it used to be the opposite. It's like, oh, you want to see this house? How about we see an offer before you see this house? Seriously, there are people like, no, write an offer first. We're not opening our doors until you write an offer. Okay, now it's like, hey, what can we do to get your buyer in? So the feeling of a seller's market, totally different. This is heavy buyer's market. We're only at 3.47. We're in an interesting spot right now, which we haven't really been in my career. The majority of people that are sellers that own the real estate have a great interest rate and the motivation isn't that great. So typically you have like some, the market is more inelastic, I think is the right economic term. It's like, hey, we need to sell our house. It's not selling. We'll drop the price. It's not selling. We'll drop the price. But now you've got this disparity. Okay. I want this number. And it doesn't cost me that much a month to keep this house because I have a 3% interest rate. I have a 2, whatever, right? I have a good rate. So I'm not going to drop down to what the market requires for a sale because I don't have to. So motivation levels for sellers are lower for those that have a great rate, right? So unless I get this price, I'm not selling because I know I'm not to have a big down payment when I buy the next one at the rate that's 3 times what I currently have, right? So that's why the off market, and there were 952 that didn't sell in the past year because we have these sellers that aren't that motivated and just simply aren't willing to match the market. It's a very interesting dynamic. Because Dorman's like, hey, this is what your house is worth. If you sell it for this, sell it for this. And if you don't, you don't, right? But they're like, no, we'll keep it. We can rent it. We have options. We don't have to sell. If you just look at active pendings and solds, you're missing half the story. And to be able to articulate that, to understand it, and then to talk to your clients about it helps them understand and then see you as a local expert, right? So this is the difference. I will short sell this because I got to go. I'm just going to hold on to it. This is the attitude that's tough to deal with when you're repping sellers. These are the people, if they want to sell, the ones that need to sell, right? Find the motivator in a bad market. The motivator, like, dude, if I got to sell for less than what I owe, I'll freaking do it. Mm-hmm. Is that motivation?
Yeah.
Because
you're losing money.
This person says, if I don't get $52,000 out of this house, I'm not going to sell. And the other person's like, can you help me sell my house? Mm-hmm. I don't know what to do. I'll do whatever it takes. Some people I met with yesterday, well, I think my house is worth $520,000. Well, you've had it for sale by owner for 3 months and everyone's told you your house is overpriced. And I'm telling you your house is overpriced. Well, I mean, if that house sold for this, then my house certainly sell for more than that. Maybe we should raise the price. Motivated or unmotivated?
Unmotivated is that off.
Am I interested in that?
And Orlando Louisville.
Yeah. So I'm like, hey, that's great. Here's where I'm at. I'll reach out next week. Check in. No hard feelings. I'm here to help you. You are friends. Well, actually, you're family of one of my friends who's like family. So anything I can do to help, it's okay if we don't end up working together. If you want to keep going the route because you really, really don't want to pay a real estate agent. That's like more than anything, don't want to pay a real estate agent. That's totally fine. I don't particularly want to work with someone who's obsessed with not paying me. Not obsessed with maximizing value, not obsessed with great service, obsessed with making sure I don't get paid. So the person here is the one that's motivated, that's going to do, and that's where the short sales are going to come in. It doesn't make sense to short sell or go into foreclosure. So a short sale is when you sell the house for less than what is owed to the bank, or the net proceeds of the sale will net the bank less than what they're owed. So the bank has to agree to, and they do not. In order for the house to sell, the bank must agree to take less than what they're owed. That does not mean that the bank will agree to take less than what they're owed. Sometimes they say, we will not short sell. We are going to foreclose and we're going to come after the owner for the difference and get a judgment against them. Typically, an owner-occupied loan that they didn't do any refinances on, the bank's not going to go after the homeowner. But if you bought the house with a 3% rate and then you refinanced it, you pulled cash out, you did a cash out refi,
then they're going to come after you. Did you like double dip and almost?
If you didn't use the money to improve the house, they probably will. Or if you had a second, the second mortgage might come after you. So a lot of times in a short sale, if you're a short sale negotiator, you're going to, as part of the short sale, get the bank to agree to non-recourse. They're not going to come after the homeowner. So if that's ever a situation where you're helping the seller out, you want to make sure that the non-recourse portion is negotiated. The reason a bank would accept less than what's owed on the property is it's probably financially in their best interest to do so. Selling bank-owned houses sell for less, sometimes take longer. The foreclosure process takes months, if not years, and is very expensive. It requires attorneys and filing of paperwork, etc. So it's a lot quicker process and typically best for the bank to take what they can get on the market today versus foreclosure and then have it on the market 18 to 24 months from now as a bank on property. So it's like, hey, we'll work with you. We'll get you as much as we possibly can if the bank agrees to not come after the seller for the difference. Make sense? So that's why a bank would allow a short sale. It's like, well, we're going to get the most money in this situation.